Imagine a dynamic world where every cent matters, and the integrity of financial records forms the backbone of success. In our modern economy, precise record keeping is not just a matter of compliance, but one of strategic advantage. How do you ensure that your banking transactions and petty cash management are both secure and accurate? Today, we will take you on a detailed journey through the world of financial transactions, exploring the workings of deposits, withdrawals, and the balancing act of reconciling bank statements with everyday cash activities. This session is your essential guide to mastering the art of effective financial record keeping. We begin by understanding the significance of petty cash. Petty cash is a small but powerful tool, enabling organizations to manage day-to-day expenses efficiently. It records every small purchase, eliminates many of the hassles associated with using checks for minor payments, and offers a snapshot of routine expenses that drive business operations. For small businesses, especially those that operate heavily on cash, such as restaurants, maintaining a petty cash fund is not optional, it is essential. By following these guidelines, you can keep your financial records clear and accurate, reducing errors and streamlining reconciliations. The journey into effective cash management starts with comprehending the basic notion of a deposit. A deposit is more than just money placed in a bank. It is a reflection of trust and a secure method of holding funds for future transactions. In practice, deposits come in various forms, including savings, current, fixed, and recurring deposit accounts. Each type of account serves a unique purpose. For example, savings accounts help accumulate funds over time, while current accounts facilitate convenient transactions on a daily basis. Deposits are not solely about safekeeping. They also pave the way for recording future income and maintaining trust in transactional processes. Now, consider the complementary process of withdrawals. Withdrawals represent the removal of funds from an account, empowering you to access money when it is needed for business operations. Whether you are withdrawing cash directly from a bank teller or accessing funds via an ATM, each transaction must be carefully documented. The right balance between deposits and withdrawals ensures that your bank records mirror your day-to-day financial activities. Understanding the modern procedures behind both is critical to avoid costly discrepancies. Let us now examine the procedure for depositing funds with absolute accuracy. Imagine you are preparing to deposit a large sum of cash. The procedure starts with verifying the source of funds, ensuring that supporting documents such as sales invoices and customer statements match the amount to be deposited. For instance, before depositing a bank check, it is imperative to verify details such as the payee's name. Always confirming that it aligns with organizational guidelines, like making the check payable to the correct company, or checking that the check amount is consistent with your records. Instructions suggest combining sales with cash receipts within the same journal to simplify reconciliation later on. A cash disbursement journal is another indispensable tool for recording all payments, ensuring that all daily arrivals and departures are consistently tracked. But challenges often arise here. What if, while checking records, you find a discrepancy? Picture a scenario where the book balance is noticeably different from the bank statement. Such differences can occur due to deposits made after the bank's cutoff time, outstanding checks that have not yet cleared, or even unnoticed bank charges and interest credits. In one detailed example, ABC Manufacturing observed that their book balance was $15,000, while the bank statement showed $14,600. This discrepancy was resolved by identifying outstanding checks, deposits in transit, bank charges, and credited interest. The result was the formulation of a bank reconciliation statement, a vital tool that helps correct accounting errors and prevent fraud. In the detailed process of confirming deposits and withdrawals, you must adopt several best practices. First, be diligent in syncing your transaction records with your bank statements. By doing this monthly, any discrepancies will be flagged, paving the way for prompt corrections. Merging your sales and cash receipts in a single journal ensures that each deposit is automatically compared against the figures on your bank statements. Moreover, keeping a separate cash disbursement journal for daily payments maintains the integrity of your records and minimizes bookkeeping errors. Regular reconciliation is not simply a practice, it is a safeguard for your organization's financial health. The narrative then shifts to a critical element in secure financial management: the application of robust security measures. When handling banking transactions, you are constantly exposed to a variety of threats, from Trojan horses that stealthily steal sensitive information, to phishing emails designed to trick you into divulging confidential data, and even money mule scams that lure unsuspecting individuals into fraudulent schemes. The digital age demands that every individual practicing banking security maintain vigilance. For example, whenever you log into an online banking session, ensure that the website's security features, such as HTTPS protocols and padlock symbols, are in place. Always keep your personal identifiers like PINs and passwords safe from prying eyes. A small misstep or oversight in security can lead to severe breaches that might compromise not only your business, but also your client's trust. Handling payments requires an additional layer of precaution. When writing checks, it is crucial to avoid unnecessary spaces between numbers and words to prevent any potential for alterations by unscrupulous parties. Cross-checking and confirming that the check is stamped with an AC payee note further ensures that the funds will only be credited to the intended recipient. Making photocopies of each check and securely storing them is a practice that adds depth to your internal controls, serving as a backup in case of disputes or errors during the reconciliation process. Training staff to follow these procedures meticulously is essential to safeguard sensitive financial information. As digital banking continues to become more pervasive, additional measures become paramount. Regularly updating antivirus, anti-spyware, and firewalls is no longer optional. Implementing session security measures, such as vigilantly monitoring for pop-up warnings or suspicious communication, helps further lock down your digital transactions. A secure and steady hand in managing these requirements can make the difference between regular operations and becoming a target for cyber attacks. In a well-organized financial system, consistent security protocols are the bedrock upon which trust is built and maintained. Transitioning to a more detailed aspect of financial operations, we now explore the topic of proof of deposit and the critical role it plays. Proof of deposit is documentation that certifies that a sum of money has indeed been placed in the bank. Unlike proof of funds, which verifies available working capital, a proof of deposit acts as a concrete acknowledgement of a completed financial transaction. Companies frequently file deposit receipts according to chronological order, ensuring ease of tracking and reference. This documentation is not just administrative paperwork, but a vital element of internal financial controls that validates each credit in your general ledger. Now, let us step into the world of bank reconciliation statements, a process that is both an art and a science. The bank reconciliation statement bridges the gap between your bank's records and your internal ledgers. Consider the ABC manufacturing example. When confronted with an ending balance discrepancy between the bank statement and the bookkeeping records, they identified outstanding items such as checks that had not yet cleared and deposits that were posted after business hours. In doing so, they adjusted their bank balance by adding deposits in transit and subtracting outstanding checks. This meticulous process not only confirmed the actual cash position of the organization, but also allowed them to capture bank fees and interest credits that had been overlooked initially. A well-prepared bank reconciliation statement serves as proof of the internal consistency and reliability of your financial statements, making future audits significantly smoother and less disruptive. This brings us to the next vital segment: processing and balancing petty cash claims and vouchers. In any business, petty cash is used to address minor expenditures that cannot wait for the standard check processing cycle, be it paying for office supplies, handling travel and taxi fares, or even reimbursing a minor expense. The process begins with receiving a petty cash claim. The employee submits a documented request, and the manager ensures that the amount requested aligns with the company's petty cash limits. A petty cash log, often maintained using digital spreadsheets, records every disbursement for transparency and accountability. The custodian then reconciles these records with the cash register at the end of each day. This reconciliation involves matching all disbursements and ensuring that all amounts have corresponding vouchers. Every voucher tells a story, a documented trail of accountability. A voucher, which can include supporting documents such as invoices, receipts, or pay-in slips, is used to validate a transaction. While a vendor invoice details the specifics of a purchase, a voucher is often an internal document used to record and later clear outstanding payments. When a voucher is prepared, it undergoes a rigorous review process involving verification by the purchase manager, recording in the voucher's file, and finally, journalizing into the general ledger. This sequence of checks and balances ensures that every recorded transaction is accurate and supported by evidence. The system might sound complex, but in practice, these steps prevent errors, reduce fraud, and make the future reconciliation process far smoother. At this point in our discussion, it is important to recognize the challenges that often accompany these tasks. Discrepancies in the bank reconciliation process, mismatches in voucher recording, and security lapses can all jeopardize the integrity of your financial systems. However, these challenges are not without solutions. For instance, ABC Manufacturing once faced a series of mismatches when a series of checks did not appear on the bank statement. The thorough investigation that followed, which included verifying deposit receipts and cross-checking voucher records, eventually reconciled the disparities. The lesson here is clear. A structured approach, combined with rigid internal controls, is the best defense against potential errors or fraud. As we draw closer to the conclusion of our journey, let us review some of the essential points we have discussed. First, the importance of petty cash cannot be overstated. It provides a flexible and immediate way to record and manage small expenses. Next, we covered the rigorous processes for making deposits and withdrawals, processes that ensure each transaction is documented, confirmed, and synchronized with both internal and external records. We then navigated through the necessary steps to confirm these transactions, emphasizing the need to merge related journals, including combining sales and cash receipts, with a separate record of disbursements. Furthermore, we examined the myriad security measures required to conduct these transactions safely in today's digitally driven world. Whether it is securing online banking sessions or verifying every detail on a check, these practices are essential in mitigating the risks posed by cyber threats and human error alike. Our exploration of the bank reconciliation statement illuminated how discrepancies should be methodically identified and resolved, transforming potential conflicts into opportunities for strengthening internal controls and ensuring record accuracy. In the realm of petty cash, the procedures for processing claims and vouchers are equally critical. The proper management of petty cash claims not only supports day-to-day operations, but also reinforces the overall reliability of your accounting system. By ensuring that every voucher is properly processed, recorded, and reconciled, you build an environment of transparency and accountability that benefits the entire organization. Throughout this guide, real-world examples have illustrated the consequences of both lapses and rigorous adherence to financial policies. Whether it is reconciling an unexpected discrepancy or safeguarding against security breaches, the principles remain the same. Precise record-keeping, diligent verification, and a commitment to rigorous internal controls pave the way for reliable financial management. As we conclude this comprehensive exploration, remember that the objective of accurate financial record-keeping is twofold. Firstly, it empowers you with a clear, unambiguous picture of your organization's financial health. Secondly, it fortifies the system against threats, paving the way for smoother audits, improved transparency, and enhanced financial security. Every step, from verifying checks to reconciling bank statements, from processing petty cash vouchers to implementing robust security measures, plays a vital role in building a resilient and effective financial management system. Every accountant, finance professional, and organizational staff member engaged in this process should feel empowered by the knowledge that following these detailed procedures can lead to not only compliance with internal and legislative requirements, but also a level of proficiency that bolsters the credibility and reliability of their financial system. Precise financial management is a team effort, combining systematic guidelines with a diligent, practical approach to everyday transactions. As you move forward, reflect on the steps and measures discussed today. Take proactive measures to review and adhere to your organizational procedures and security guidelines, and consider further reading on mobile and internet banking to stay updated with current financial practices. Mastering these processes will not only protect your resources, but also enhance the trust placed in your financial records by stakeholders and auditors alike. Thank you for joining this journey into the essential world of banking transactions and petty cash management. Armed with these insights, you are now equipped to tackle financial discrepancies, safeguard sensitive information, and maintain impeccable financial records. Embrace these practices and build a future where every transaction exemplifies precision, security, and trust. Review and adhere to the outlined organizational procedures and security guidelines.